today we're going to talk about getting construction projects funded. So I see so many people looking and requesting loan funding, and their requests are just terrible. Make sure it's the right fit for that lending institution, and maybe it's a debt fund, a bank, credit union. So all these different banks, credit unions, and lending institutions, they have a certain footprint they like to lend in. They have a certain asset class, a certain loan to cost they like to lend on. So instead of blasting out these loan requests to 100 banks, be very kind of selective on who you're sending the deals to, because the problem I see out there a lot is that people want to get the best rates, so they're going to 5 or 6 different mortgage brokers. The problem is those mortgage brokers a lot of times are bringing it to the same lender.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. And today we're going to talk about getting construction projects funded. Larger development projects and the process behind getting these larger deals funded and what you can expect in the during the process. And really, I think to get the process started, it's really about putting the notes out there and writing just a one-page summary of your loan request and making it really simple, and then building off of that. So put your thoughts in a Word doc or on a handwritten piece of paper. I'm buying this 5-acre parcel. I'm going to be building 92 assisted living facility units. Here's my track.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Different banks, credit unions, and lending institutions, they have a certain footprint they like to lend in. They have a certain asset class, a certain loan to cost they like to lend on. So just knowing that. So instead of blasting out these loan requests to 100 banks, be very kind of selective on who you're sending the deals to and who are the most probable. Because the problem I see out there a lot is that people want to get the best rates, so they're going to 5 or 6 different mortgage brokers. The problem is those mortgage brokers a lot of times are bringing it to the same lender, and then these lenders just think, okay, this deal is just getting shopped everywhere, I'm not going to spend time on it. Whereas you should be more selective. The way you could be working on these projects is usually a mortgage advisor or a commercial real estate advisor is going to give you an agreement to sign, which says, hey, I am going to register your loan request with these 5 or 6 lenders. Okay. And that's signed by you and signed by the lender or the broker. Right now, you know who they're bringing the deals to and shopping it to. And then if and when you might want to talk to another broker, you already say, hey, listen, I have these 5 lenders. If you have some sources, please don't bring them to these 5 lenders, because I'm engaged with another broker on these. He's registered these loans and he's the pure procuring broker. So that's kind of how it works. It's okay to work with 2 brokers, but I wouldn't do any more than 2 brokers. If you're working with 5 or 6 brokers, your deal's getting shopped around and it's going to lose its face value. So going back to wrapping this all up is really spending time. I'm spending more and more time with COVID, but on Zoom, meeting with my potential clients and borrowers and really like finding out and asking questions and making sure I'm not missing any pieces, just diving into the questions, diving into different scenarios. And then where I think my value is for my clients is that I'm a direct lender on a lot of products. I also broker out. So I have a platform which encompasses, pretty much every loan product. So I'm not going to put somebody in a deal because I think, this is the bank it needs to go with. When in turns, I know maybe we could structure it over here and there's less equity needed structuring it this way. And at the end of the day, usually when you bring in less investor capital, it's higher returns for those investors in the deal, right? So you don't have to dilute your returns by getting higher, better debt, higher leverage, lower cost of capital. It's a win-win. And so that's what I do. And I try to do that at a high level. And that's what any good mortgage broker will do. So put together a good summary, work with a broker you trust to put this summary together, the business plan, your pro formas, make sure everything's dialed in, and then go out to the market and don't rush it. This way you can get quick feedback. It's not shopping around where every bank in town talks and knows, hey, oh, did you see this deal? You don't want to be that. Anyway, that's my episode for today. Hope you enjoy it. Anyways, if you want to connect, go ahead and book a call on my calendar down below. Please like and share this on YouTube, or if you're listening on Lipson or iTunes or another platform. Appreciate the support. The more likes and reviews I get, the more it helps my channel grow. The more podcasts I do, the more sponsors I could potentially bring in. Anyhow, thank you very much and have a great day. We'll talk soon.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.